Thanks so much for tuning into Talking Points. I'm your host, Shah. When trends change, they do so at times without there being a lot of noise around it. People who are able to identify some of these trends earlier, and if these are mega trends indeed, tend to make outsized gains by investing early. The key is to be able to identify some of these trend changes and have the conviction to back up the truck and load up on those investments. Now, my conversation today with Anand Shah probably focuses on some such things because while I thought we will talk about one particular trend, which is the advent of the B2B businesses, maybe not just in India, but the world. But I think we've got room for some more trend changing conversations today. Anand, great having you. Thanks for joining in. Hope all is well.
Thanks, Iraj. Very good morning to you and your viewers. Yes, it's always a pleasure to be on your show.
Thank you, and always a pleasure to have you. Anand, before we dwell into the minutiae, just a quick broad brush thought. There's a bit of a leadership that India is exhibiting in that the markets are resilient to some bit of minor volatility around the world. The valuations have remained at the top of the leadership pack for a while now. Uh, do you reckon that this can continue, or if indeed the world were to have a bit of a pullback, then would India underperform because India has already had a share of large outperformance?
So I think, to be very honest, the leadership is coming from also the resilience. So we have to ask ourselves whether this resilience is here to stay or we are vulnerable. And to be very honest, it's not only about India. Most of the emerging markets have actually behaved very well in the sense fiscally. So while the developed world really spent their way out of the crisis, we have done a hard work. We really didn't spend so much money, and to that extent, we are to that extent when the US rate hike is happening, when the liquidity is getting tight. Uh, we are relatively more resilient than many a developed world also, and that reflects in the currency. While it is depreciating versus dollar, is actually appreciating versus other developed nations. So that's one piece. The other piece which India is providing today is also a stability, stable policy making to some extent, and stable government, which we are already seeing. So that stability is also something which is attracting foreign investors. When you see that in light of what's happening in the rest of the world, uh, so that's the second piece. Third piece, to me personally, is something more structural that's happening and happening at a very, very large scale. So the way we handled the COVID vaccination or the UPI payments that are happening, the DBT transfers that are happening, providing electricity, water at the grassroots level will have a lasting impact. So when you provided education, it had one impact, but when you provide the basic amenities from healthcare to water, to electricity, to toilets, to LPG gas, it will have lasting impact in terms of productivity of the people at the bottom of the pyramid. When they have extra time left, if they have less illness, it will have a lasting impact on the GDP, so which is more long term. It will not have immediately on the short term thing. But these are the few things which people are noting sitting outside India. That these are happening over a very, very large scale. The entire UID was a large project which has.
Yeah, that's true. I mean, as a lot of people are now saying that some of the pieces that India has been able to build are unique, and in that sense, it kind of helps India in a material way compared to the rest of the world. So, Anand, I presume your thesis is that this outperformance, because of the resilience that Indian markets provide, might not fade away too soon.
Yes, so not to take away from the challenge that India has, we have energy dependence. I think I can't take away that point and that reflects in the deficits that we are running. Uh, we have losing some forex, reserves. We are spending that, and to that extent, we can't afford high energy prices because any high energy prices would in a way slow down our India consumption story, which is all 1.3, 1.4 billion people getting from single income to double income, able to spend more. But that again gets derailed for a year or two if you have high energy prices. So we are a little better off given coal dependence and all, but nevertheless can't take away that fertilizer we are spending a lot of money. That's become very expensive. Oil has become very expensive. Government has been able to use fiscal room they have to so far protect the consumer, but this can't sustain for very long. So that's a pain which one needs to be aware of, that the Indian economy has at this point of time.
Okay, so watch out for that factor, and hopefully, if oil prices, well, hopefully, if China, as and when, if and when China opens up, it doesn't have a very material impact on oil. Hopefully, but that might be a outsized point. Okay, but this conversation. So I just wanted a brief view from on markets with you, Anand. But I was more interested in the other conversation, when I read the note that you guys have written recently, or the slide deck that you guys have prepared recently, I thought a couple of things stood out for me. And in that, the pre 2020 versus post 2020 behavior of the profitability metrics of B2B versus B2C companies, and the market acceptability of that trend change to an extent. Now tell us, what have you observed when this comes? Because a couple of people have said that maybe this could be a decade of B2B as opposed to the previous decade, which was entirely B2C. Tell me a bit about your thoughts.
So I think if you see for 5 years, almost for 5 years, we used to start with a 15% earnings growth rate projections for Nifty, and we used to end up flattish. So we had actually, while the top down was okay between 2015 to 2020, pairing demon and GST implementation, those were small, but there was nothing macro going negative. But at the micro level, we had a lot of challenges. Bank profitability because of the NPAs in manufacturing and infra. You had generally slowdown in the economy post NBFC crisis. So overall, we had negligible earnings growth rate for 5 years, which you ask me personally, in 20 years of the career I had, I didn't see that long period of having no earnings growth rate at an aggregate level. And surprise, surprise, in 2020 onwards, you see EPS doubling. And when I went into and I said, what changed? And that was something which, when we saw that you had almost 5 years, maybe a decade, when the B2C companies are actually doing well for a decade now. Since 2008, 2007, when last we saw the B2B companies doing well, if you recall, just before the GFC. And the B2B companies were suffering through the decade. And that changed in last 2.5, 3 years that we have seen. You have a lot of manufacturing doing very well. And I go back into and is it why? When I go back into my analysis of these numbers, one thing was that in that decade, and even 5 years before that, so sometime in 2003, 2004 is when China started building a lot of capacities in manufacturing, which created havoc in manufacturing outside China, because they had not only capacity enough for themselves, they had capacity for the rest of the world also that they created. They had a lot of advantages. They had very supportive government policies. They had low cost of energy. They had very low cost of pollution also in the early days. While that has changed in last 6 years, they had low cost of manpower. Manpower availability was very good. That is also changing. So there were a lot of factors coming together, and most important being government support, massive support to attract manufacturing into the country, led to lot of capacity creation ahead of time, leading to they also making sure that there was a deflation in the rest of the world, which means the consumer companies in India benefited because the input cost never went up. But it means it was a very tough period for manufacturing. And you've seen since then, many of manufacturing industries not only in India, outside China, in Europe, US, have shut shop and said, I'll get it from China rather than, so, a lot of manufacturing guys said, let's close the shop, go to China, get 5 containers a month and distribute it here. That was the business model, not only in India, rest of the world. I think that is changing. Slowly, steadily, China has tightened its noose around the pollution. Uh, they have withdrawn many incentives for manufacturing. Their labor is becoming expensive. Their energy prices are becoming expensive as they embark upon green decarbonization of their own economy as they became rich. I think that's the trend I was talking about, that is changing. Manufacturing, whatever has survived outside China, uh, if we do the right things, can do very well in next decade.
So let's assume that the trend is that manufacturing could do well. Within that, there will be some pockets which will do well, some pockets which may not as well. Where are the early signs, Anand, of companies doing well, which may have a lasting cycle? So there are companies which would have done well thus far in the last 3-4 years, may not really have a very long cycle, and some which might have a really long cycle. So where is it that you've seen both the evidence of a good start and the longevity of the cycle?
So obviously within manufacturing, you have multiple layers. You have commodity manufacturing, which was the most hit because that was the easiest to export. And that's where we believe it's generally more polluting also, it's generally more labor intensive also. And to that extent, there is significant shift happening for many low-end manufacturing to Vietnam, Burma, Bangladesh. You talk of cotton yarn. They're also shrinking their capacities in steel and aluminum, at least in steel, I can say, given that it's also very polluting. So some of the low end of manufacturing will always remain cyclical. But the point here is that the mean around which it varies, which goes up and down, I think that mean would have moved up. To give you a simple example, they had a 13% export rebate on steel. Means if you export steel, you will get 13%. Now, if that is removed, means steel have structurally moved up by 13% because China's export price, everything else remaining constant, has gone up by 13%. Getting me? So I think that's the one end. The other end of manufacturing is value-added manufacturing, which is not that cyclical. You talk of bearings, you talk of cottons, you talk of garmenting. You can go on and on. Engineering goods, which are not very cyclical, but they are long cycle sales. So before you get empaneled with the OEMs, it's a cycle. You've seen that in specialty chemicals. It's so slow and steady, but now it's gaining momentum as now more and more OEMs, more and more the corporates are also looking to do China plus one. We are already seeing the advantages coming through for many MNC manufacturing, because for them it's faster. The approvals are coming in much faster because their own subsidiary. So that's the second end. And then the third is the technology-led manufacturing, where PLI comes in. So I think that's where we'll be the last, because to be very honest, we have to first develop the knowledge to do the high-tech manufacturing. And that's where the PLI comes in, where we can attract early on and not wait to first get the low end and the mid-end manufacturing. We are also at the same time parallelly trying to get investments into high-end, high-tech manufacturing also. You're on mute, Neeraj.
Okay. So varied facets of this could happen. Just one quick question thrown in here before I move on to the other piece. There is an advent of some themes, Anand, which are very recent in nature. And defense is a prime example, an entirely B2B or B2G space, so to say, but has come of age suddenly because it's the new buzzword. There is a ready government willing to push in the private sector for Atmanirbhar Bharat. Is that an example of a B2B, I mean, B2G, but cloaked as B2B, which has suddenly found some legs? And does it have the tailwind and the runway for growth?
Indeed. So maybe I didn't talk about it, but the import substitution, we already have a large import bill also. There's no doubt in my mind that we can do that manufacturing also. And that is one of the opportunity. Defense definitely, is been, we are a large buyer of that goods. And to that extent, if we can indigenize it more and more, not only we manufacture for India, but then we can also overall manufacturing for the smaller nations. And we have some examples already there. So yes, that is one of them. Definitely where we can see the existing. So again, the the key from the listed space, key from the capital markets point of view, I think the immediate benefits are the guys who have survived uh, the carnage that happened in the manufacturing. So immediately, the companies which are there in manufacturing, we survived the downturn of almost a decade, a little longer than that, are the ones which will be immediate beneficiaries. Uh, the new age manufacturing, the new trends of manufacturing will emerge, but that is not yet. We are not yet there. That's linked more to PLI and all that. But if you go back, even in last few years, we had you know white goods manufacturing also as a segment which has come up only more recently. So that's again import substitution. Do we actually import the entire air conditioner, or we do only import a compressor? Even now, can we manufacture that compressor also? So that's the way.
Got it. Okay. Two more trends that I would want to talk to you about. One that you guys have been talking about for a while, finally finding acceptance, which is PSUs. But before I talk about PSUs, I want to talk about banking, because you made this very interesting point before we started our conversation about how there are, in some ways, there is some bit of a differentiation in how banking as a space might behave compared to what it has done in the last 10 years. Can you elaborate a bit on that?
So again, there you had, if you go back from 2016, we had a very large event called Asset Quality Review. June 2015, to be precise, is when the then RBI Governor Dr. Rajan said, "Let's do AQR, which is Asset Quality Review of every banks," and that led to many manufacturing and infra companies which were struggling from GFC, and then subsequent many disturbances that happened at the policy level within the country. We had a massive NPA recognition. What that led to many of the state-owned banks, but otherwise even within the private sector banks which had exposure to infra and manufacturing, had to pay the price for that. While there were pockets of financials which were not exposed to B2B but were exposed more to B2C, they continued to do well, and they even got re-rated in that period. What has now changed more recently in last 2 years and in next few years is while you have provided for most of the NPAs, now as the economy recovers, manufacturing recovers, infra, the utilities requirement, the power requirement goes up, we are seeing more and more resolutions on the past NPAs. There are significant recoveries. And in those 5 years, 6 years, which are very difficult for these banks, they also have incrementally lent to B2C, incrementally lent to more AAA. And to that extent, today, that starting point, they have high gross NPAs, low net NPAs are provided for most, and their asset book is pristine. Not generally speaking, but I'm talking about if we were to do analysis on few banks, they have good quality borrowers at this point of time. And to that extent, next few years, we will have less of slippages compared to the historic 5 years, and we'll have more recovery. And to that extent, what we saw between 2004 and 2007, the similar cycle we can see for select state-owned banks and select private sector banks which had exposure to the infra and manufacturing.
Very interesting. And therefore, my question that maybe in retail, the larger banks will still continue to dominate because people would gravitate towards a better technology, larger network, if you will, or what have you. But wondering if the smaller banks which are into corporate lending can finally come of age, because I'll tell you why. The most common refrain almost every single time that a conversation around the tier 3 banks, if you will, if I can classify them, that comes up, is that boss, look at the past 10 years, kuch nahi kiya inhone. nothing will happen. Let's just stick to the large ones. Do you sense a change there?
I think it's very true, and we are seeing in many industries, be it steel, be it telecom, be it cement, and even in banking, where there has been consolidation. In the sense, the top six, the top 10 banks are becoming bigger and bigger, and they're taking lion's share. In that sense, the large banks are growing faster than the smaller banks. So, to be very honest, that reflects in the market caps also. So, market caps have already gravitated towards the large banks, saying, look, so the capital markets have already given a verdict that
Right.
these are the large banks which are going to dominate the banking space. Uh, when it comes to smaller companies, you need to have your unique moat. You need to have some right to win. Otherwise, it's tough. And that we do our bottom-up analysis for every company, every small financial NBFC or a small bank that we invest in. We try to see, do they have a right to win despite of the dominance of the large banks? If that's the case, we do buy, but it's difficult. So to give you a simple answer, yes, it's tough for them. But having said that, would there be a couple of smaller banks which can emerge and survive and thrive? Yeah, there is always a possibility, given the banking industry is also growing very rapidly.
Got it. Okay, one final piece on PSUs. I mean, month of October was a boon for PSU banking market caps. But by virtue of what is happening in defense, for example, or a couple of other pockets, I mean, the government's focus thrust, even on sectors like railways, is bringing about some bit of a, how do I say, a positive sentiment towards PSUs at large. You guys have been proponents of select PSUs, PSU banks, so on and so forth for a long time now. Do you finally think they've come of age, and do you finally think that there could be the market verdict on PSUs also coming to the fore, if not already?
So I think the way we see the state-owned banks or state-owned companies, we see similarly in the private sector. We look for growth, moat, right to win, sustainable competitive advantage, and third, valuations. For these companies, valuations was never an issue. The issues were whether they have growth going for them, whether the sector is growing, and if the sector is growing, can these companies sustain market share? So if you see, if there is a state-owned company which can not only sustain market share, can actually gain market share, nothing like it. And then the next question you have to ask for ourselves is, do they have a right to win? They have a sustainable competitive advantage to survive downturn. Because that's another thing that we have learned hard way in last 10, 15 years, that many are in the previous downturn, many companies didn't survive. So you have to also survive downturns, and we are seeing more and more global macro challenges which are there in the marketplace. So those are the two things which are very important. And then lastly, we look at management, whether they have a correct management to continue to gain market share, continue to win in the marketplace. If those are the ingredients in the place, so we are very selective.
But you're finding opportunities.
Yes, we are finding opportunities. The valuations were very attractive, not anymore, but valuations were very attractive. So the margin of safety was much better 6 months back, 12 months back in this case.
Okay. Well, this was insightful, Anand, but would love to maybe even read a bit more about this by virtue of some things that we can do together, and talk to you more about this phenomenon or some other phenomenons over the course of the next few months. But thank you so much for spending the time today and talking to us.
Thanks, Niraj. Always pleasure.
Yeah, it was lovely talking, and viewers, thanks for tuning into this conversation of Talking Point.